Welcome back, investors, to Ticker Time News. I am Adam. Thank you for joining me for the After Hours show or our micro close live stream. So today, remember, and every day, the most important thing is answering your questions. So if you do have a question, leave in the comments. We'll go over it live during the show. All right, the S&P 500 rose 1.1% on Wednesday in a relatively broad-based advance led by none other than growth stocks. Yeah, the ones that get beat down the most. They usually pop the highest on days like today. Now, the Dow Jones, it gained 1%, while the Nasdaq Composite, it outperformed with a ginormous 2% gain. And the Russell 2000, a very close second place with a 1.9% gain. Now, investors assumed a dip buying mindset today. Underrated, not underrated for sure, by any means. Undeterred by a larger than expected 1.4% month over month increase in the producer price index. Yes, the PPI for March. Estimates were only 1.2%. So inflation is red hot and we know it. And it is a problem that the Fed is going to have to face. Many of us believe that the Fed is ill-equipped to face this problem. And they're already behind the curve on this one. They should have already taken action months ago. Last year, they should have taken action on this inflation, but they didn't. They missed their mark, and now, unfortunately, it's recession, right? The Fed is running out of tools that it can use to help right this ship. And of course, there was a massive miss on earnings by JP Morgan Chase. Ticker symbol is JPM. Get the cursor over here on the right screen. JPM for JP Morgan Chase. They missed their estimates and their stock dropped, what was it, 3% and some change? Yeah, 3.22% today. Off of that big miss. I mean, look at this. I mean, bank stocks have just been getting hurt. And you would think in this era of rising rates that banks would be doing good. But no, when you tie that into inflation and that story, it disappears. At the beginning of the year, I mean, look at this trend line right here. It's nearly perfect, capturing the top right here made as last earnings report. And then another top here for it on February 11th, and it sinks down and gets rejected again at this line here on March the 29th, and now it's down further. So it's not looking good for bank stocks. At the beginning of the year, at the end of last year, I thought that regional banks had the best bet of outperforming, if you will, while interest rates were rising. But now that theory has kind of unraveled a bit. Same with my overall market theory, even though it's still kind of holding up for now, but I'll talk about that in just a moment. Now, the S&P 500, go back to that chart. SPX is the ticker I use for the S&P 500 in TradingView, and there is a link in the description to a free account to TradingView. So I'm going to take away volume here. Volume is steadily decreasing, so it doesn't take much to move the market when that's happening. RSI, well, let me back up real quick. Back here, the end of March, right? And even at the end of last week, which was the 8th, I was talking about the market needing to cool down because the RSI was running hot, the money flows were running hot. We needed the market to cool off so that the market could continue on a march forward. And during that time, or since then, yesterday, today, RSI, look at this. It has come down nicely, and it is now sitting at a 43.1. Money flows, they have also come down nicely, sitting at a 48.4. So really nice to see this cool off, even though we had this nice 1.1% gain in the S&P 500. This mark that we're at right now at 4,400, okay, there's a good support line right there at 4,400. Now, I think that what we're going to do is we have the high that I think we're going to reach. It's going to take some time to reach this high, but I do believe we are going to reach it. And then we have this low down here on the bottom red box highlighted in yellow. Now, I think we're going to bounce around in the middle for a while. I think we'll have our, maybe we can string together a couple of green days in a row and then maybe a few red days in a row. But I think we're going to bounce around a little bit until the next Fed meeting. And then depending on what the Fed does at that meeting, we'll determine if we're going to move higher or if we're going to move lower from where we are. But I think as we get to the second, the third Fed meeting, there's going to be a big red sign flashing for the Fed. And it's going to be, they have to choose a path, right? They're going to have to either go left or right. There's no stopping, turning around. They have to go left or right. One way is going to be tackling inflation. And in tackling inflation, that's going to cause a lot of other problems. But if they go after these other problems, like a recession, then they're not going to be able to tackle inflation. So they are really at a catch-22, and it's approaching quickly. They don't have many tools available. They don't have much time left to either to use these tools to get us out of a recession. And I really think one's coming in 2023. So, I mean, this is going to take some time to play out, right? But imagine if the Fed, rate hikes next meeting. We get rate hikes the meeting after that. But then the Fed sees the big flashing light for a recession. And the Fed doesn't want to go down to a recession or stagflation. It's very possible that the Fed makes a U-turn. And if the Fed made a U-turn from quantitative tightening back to quantitative easing to lower rates some to get us out of the path of a recession, then that would turn the markets around and that would send us to our all-time high. So in my overall S&P 500 thesis, that's the one big thing that changed. Is I am less confident that the Fed is going to make the right decision. And I think it's going to lead to a recession. And if it does, and that's the direction that we go, then we're not going to get back to these all-time highs, right? So if the Fed U-turns on adding up the rates, right, kicking them up, that's when I think we should get to an all-time high. But if the Fed stays on the course of rate hike after rate hike after rate hike, I think the market's going to continue to go down because earnings surely are not going to come in and save the day. Earnings are going to show that, guidance isn't looking so good. Nope, guidance is not looking so good. The second half of this year is going to slow down dramatically. That could, in itself, actually help lower inflation. Because when demand comes down, so does that inflation. So keep that in mind as we move forward in time. And no, I didn't make that line up to rhyme. Boy, on a roll. All right, so the S&P 500, a very important technical note here. The S&P 500 did reclaim its 50-day moving average. That 50-day moving average right now is at 44.22, okay? Just slightly, right? We closed at 44.46, and the 50-day moving average is 44.22. And remember my saying about the 50-day moving average. Bullish above, bearish below. So keep that in mind. But I do with the S&P 500, I think we're going to move sideways. We're going to get maybe a few-day rally, maybe a couple-day drawback, couple-day rally, a few-day we're just going to move around going sideways to the next Fed meeting. And then that's going to be a crucial point to where we go next. 4,400 on the S&P 500. That looks like a good, solid, lots of reactions on that line. So maybe we could bounce around between that line and then up here at around 4,500, 4,490. Maybe we bounce in there. Maybe we go even a little bit lower. But here's the thing, with the PPI data coming out today showing inflation at a 40-year high, well, why did the market rally? Why was it growth stocks in particular that rallied? So a couple things to keep in mind. The market's not being rational at this moment in time. Okay, so there we go. The S&P 500 did regain its 50-day moving average. Now, 9 of the 11 S&P 500 sectors, here's where they stand. 6 of them advanced today at least 1%, including a 2.5% gain in consumer discretionary. Airline stocks were particularly strong after Delta Airlines, ticker symbol DAL. Well, they were up big because they had beat its top and bottom line estimates, right? Look at this beautiful climb, 6.2%, just soaring up there. And if we get a better look here, I mean, really, we had this drop off from earnings back here in February, March 2021, April 2021. But it's kind of been moving sideways. Airlines had a big drop off during the beginning of March. So good to see them coming back. I just did an airline video. Watch it if you have some time, if you haven't already. It's pretty good. There's a lot of pent-up demand. And Delta's CEO on the earnings call, they even provided a very upbeat outlook on bookings. And bookings were huge in the airline industry. Also, not auto, but also the cruise line industry. There is tremendous demand for cruise ships as well. So keep an eye on them during the earnings season, because airlines and cruise vessels like Carnival, I just did a video on Carnival. It came out earlier today. Watch that if you have some time too. There is just tremendous demand for travel right now. So keep your eye out on the travel-related stocks. Now, in relation to Delta's big day, the U.S. Global Jets ETF, and the ticker symbol is JETS, JETS. Look at this, my friends. Look at this, 5.3%. I mean, the ETF has definitely been in a downtrend here, but because of Delta's big news, Jets up 5.3%. That's incredible. Now, financials, they were down 0.1%, and utilities were down 0.2%, and those are the sectors that closed the lowest. Now, with financials, they were pressured by JP Morgan's disappointing earnings results and a second straight decline in treasury yields. Now, talking about treasury yields, let's go to the 2-year. Remember, you can do this with me at home. US0 to Y. That takes you to the 2-year. And you can see that's pulled back significantly. Last week when we looked at this, I told you about the arch that was starting to form here on the 2-year, and it's definitely formed. The 2-year decreased 5 basis points to close the day at 2.34%. It's at 2.3, rounded up to 7 right now percent for the next day. Because remember, the market closes right here, and then it opens up at 4 o'clock, because today's the 13th, right? But this last candle that just started, it is for tomorrow. So that's something that's a little bit different here when we're looking at treasury yields. There's already a green candle. It's up 0.47%, but that's for tomorrow, right? For today, it closed down 5 basis points, and it looks like it's already climbing for tomorrow, so we'll see how that rolls out. Now, the 10-year, it also decreased today, US 10, and then Y for the 10-year yield, and you can see that it was also down, but it decreased 4 basis points today to close at 2.69%. Now, it's already back up to 2.7% as we see it right now, because remember, the brand new candle that is the furthest to the right, it's just a tiny little sliver right now. That's for April 14th, which is tomorrow. Today is April the 13th. Now, here's something I don't usually talk about, but the US dollar has been pretty strong right now. The US dollar index actually fell today almost 0.5% to 99.88 points. So down a little bit, but it has been strong. And 99.88, that's still pretty strong. Now, the decline in rates did help alleviate some of the valuation concerns in growth stocks, including the mega caps. And that's why they were able to just run today. The Vanguard Mega Cap Growth ETF, the ticker symbol is MGK. It rose 1.8% today, right? This is the Mega Cap Growth. It rose 1.8%. You can see that on the right-hand side of your screen. Versus a 1.1% gain in the Invesco S&P 500 equal weight ETF, and the ticker symbol for that is RSP, and that's your S&P 500 equal weight. So every stock in there has an equal weight, up 1.1% today. So growth definitely took hold. Look at this wild card here, CrowdStrike. R. There we go. CRWD. I'm working on a video for CrowdStrike. It should be out tomorrow. CrowdStrike up 7.3% today. It was upgraded today, and it has some fascinating technologies that were just approved to work with the U.S. government. So that's big. They also have this deal with Mandiant, which was bought by Google. So some great things happening there. You'll love this video on CrowdStrike. I think I'll call it the best cybersecurity. Maybe should I run with that? CrowdStrike as the best cybersecurity stock. I think I might go in that direction because it certainly is. Just wait till you hear all the information in it. It's just incredible. Now, demand for treasuries, it was presumably influenced by the peak inflation narrative and cautious sounding commentary from JP Morgan CEO Jamie Dimon when he was talking about the economic challenges ahead. And then the PPI report wasn't that surprising after the hot CPI report yesterday, suggesting the report was already priced in. And then we get to the crude oil of it all. It flirted with $105 a barrel today. It closed at $104.25 a barrel, up 3.5%, despite bearish inventory data from the EIA and a downwardly revised 2022 global demand growth forecast for the EIA as well. Now, on the economic front, let's go a little bit deeper on the producer price index. Now, I'm sure, I haven't done this before, but I'm pretty sure that we could. If we look up if we look up, I know it's here. Is this the right one? I should have know that. What does that say? Construction final demand. Would that be it? Or would it be this one? Okay. I should have done this before looking into it, but the producer price index, so I'll just leave that on the screen for right now. But there's a few things I want to say about it. With the producer price index, the final demand jumped 1.4% month over month. Okay. In March, the estimate was only 1.2%. And there was an upwardly revised 0.9% increase in February. Now, the key takeaway from the report is that it's a signpost of potential profit margin pressures that are going to intensify if consumers start showing more resistance to price increases. And I think consumers are getting pretty pissed off about price increases right now. Now, beyond that, it's another reminder that the Fed needs to get aggressive with its policy and to get these rampant inflation pressures in check. That's it. Straight up. The Fed has got to deal with these inflation numbers. We cannot continue like this in an economy where everything is costing more. Something will give, and it's not going to be great. All right. Another point of data, the weekly MBA mortgage applications declined again 1.3% after its big 6.3% decline in the prior week. So they just keep going off. And why is that? Why are mortgage applications going down? Why? Let me know in the comments. Why do you think mortgage applications are going down? Well, it's because interest rates are going up. It's pricing people out of the market. People who could have afforded, I don't know, a $450,000 home at the beginning of the year, maybe even back at the beginning of March into February. Now they can only afford $350,000 for a home. So something is going to have to give. It cannot continue this way with everything costing more. I mean, the fertilizer shortage that we're going to have is going to create a reduction of yields in crops. That's a guarantee. So that's going to hit us with food shortages, which is just going to make inflation worse when it comes to food, something that we all need. So the Fed's in trouble here. It's almost unprecedented. They don't have many tools to deal with it, and it's unfortunate. All right, here's where we stand year to date. The Dow Jones is the leader at down 4.9% year to date. The S&P 500 down 6.7% year to date. The Russell 2000 down 9.8% year to date. And the Nasdaq is in correction territory again, technically that is, down 12.8% year to date. Now, if you could help us out, that would be great. Smash that like button, share this video, and come beat the market with us by clicking the first link in the description. At the very least, you would be helping us to create this content. And if it's your first time watching, click subscribe. For Ticker Time News, I'm Adam. Thank you so very much for watching, and I'll see you in the next video.